Hello, this is Matt on the Moon Lambo channel. I'm sorry, but something is broken. The crypto market is absolute garbage again today. You guys have taken a look at prices, haven't you? Yeah, in case you haven't, I'll pull them up to your dismay in just a moment here. But something is broken. And look, I'm not saying it's something that's as systemic as what happened during the depths of the bear market in 2022. You know what happened with FTX and all the rest, and all sorts of firms going bust. I'm not saying it's that, but I am going to tell you that that liquidation event that we had on October 10th, there's a new thesis here that's been going around, and some new information that has been spread quite widely in crypto just within the last day or so, in fact. And there are a lot of reputable people who are saying that's actually what's causing this, okay? The liquidation of it, the ramifications of that are actually still rippling through time right up to this moment, and we're still dealing with it. And I have to tell you that I find the thesis rather compelling, which is why I'm going to talk about it a lot in this video, because if you're wondering why the price of your XRP is doing what it's doing, well, folks, I think I might have found the problem. I'll tell you that. So hang with me if you want to have the full understanding of this. Now, the good news is, even though prices are in the gutter, and even if this thesis is correct, and I do find it compelling, even if that's the case, that's actually a good sign. Almost certainly, actually. And you'll understand why. So, like, once I go through in detail what has actually caused this and like, what the thesis is, and assuming it's correct, and again, you'll see why I find it highly compelling. We're almost, it would mean for high probability chance that we are almost at the bottom of this. It has to do with forced selling of at least one major market maker through a contractual obligation from a lender that they work with. So that's that's a kind of at the core of the thesis. I got way more to tell you about it, but in a nutshell, that's it. And also this is coming from some of the most respectable and well-connected people in all of crypto. You know, the type of people who actually have careers in finance decades long, and they know people in all of these market-making firms and cryptocurrency exchanges, hedge funds, so on and so forth. It turns out, like, for instance, there's one guy I'm going to reference, Tom Lee. You might have heard of him. He's a co-founder of Fundstrat. He's a CNBC commentator. He's on the news all the time. He's got a pretty damn good track record. And he has pretty well hinted on national television. He's like, yeah, I know some names. He would not say them publicly, and that's fine. I can respect that. But he actually knows, it sounds like anyway, which market maker is actually in distress, and that is what's causing all of this. That's his thesis. Raoul Paul's heard the same rumors, and a bunch of others. So I'm going to break it down, but if you really want to understand what's broken and why it's happening, and why maybe we shouldn't be as afraid as we are right now, well, just hang through to the end of this video. Like, I'm going to get through it in a particular order here, but it's definitely worth hearing all of this. Now, as I record this video, it is 11:02 a.m. Central Time, Friday, November 21st, 2025. XRP is $1.94. Bitcoin at $84,548. So, of course, the sky is falling. XRP is low just a few hours ago. Dropped as low as $1.83. Bitcoin dropped as low as, what, $81,149. And you can see, this is just 24-hour chart for XRP and Bitcoin. As I flip back and forth between them, it's the same damn chart. The market's obviously moving in tandem right here. Now, I did share this post just a few hours ago, just this morning here. And I think it is important to have this perspective. I simply wrote, have some perspective. Since 2017, Bitcoin has had roughly 24 pullbacks of 25% or more. And the entire asset class, including XRP, moved in tandem every single time. During each of these roughly 24 price crashes, people screamed that we were entering a new bear market. But out of those roughly 24 major pullbacks, only 2 were actually the start of real bear markets, 2018 and 2022. Also, crypto bear markets only last about a year historically, so not exactly the end of the world either way. Okay, so I'll be clear here. I am still not convinced that we're in a bear market. There are things that can happen that would convince them that we are. More on that just a second here. But I am not there yet. I'm just not there. Because, look, I'm telling you, I have lived through every single pullback over the last 8 years, and every single one was the end of the world. Some of them were bigger than this. There were ones that were bigger than this that absolutely were not the start of a bear market, but people were saying it's the start of a bear market. I am not yet convinced. I don't know for sure. Now, to be clear, I don't know for sure. I'm just telling you, like, you have your opinion, I have my opinion. I'm articulating mine publicly. I admit I don't know, but I feel the way I feel. And actually, if you just hang me through the rest of the video, you'll see why. I actually feel more strongly about that despite the pullback today. We'll see, though. But it's true. And if you just have a long-term mindset, you're going to be fine anyway. I'm telling you, bear markets are short. Look at how low we already are at this point. And so, like, if we're even close to the bottom, even if it does go a little bit lower, again, bear markets, they don't last that long. It's a small percentage of the time. We're in a bear market, historically, like in the stock market, like 20% of the time. So if it's 20 to 25% of the time in crypto that you're in a bear market, not that bad. And you have opportunity there. Like, we're not going to be down this low forever. It's just not the end of the world. People need to chill. The fundamentals of crypto don't go away just because price goes down. Think about it. Like I just said, going back since 2017 to about 24 price crashes of over 25% rather. None of those price crashes were an indication that the things that make people value crypto were no longer valuable. That is not what any of that ever meant. And it's not true now. We're still fine. So I'm going to hold the same amount of crypto now, yesterday as I did today. I'll hold the same amount tomorrow. And, unless I add more, it's going to be the same amount in a year. It just doesn't matter. Now, as far as one of the things that would make me think that maybe we are actually entering something a bit more serious than just a dramatic pullback. Because again, as new data comes in, I'll change my mind if necessary. There's a post here from Credible Crypto noting that he was going out of town and he's basically kind of having a fun way saying, folks, you got one job only, keep us above $74,000 for Bitcoin. And he's cited that level many, many times. That's his line in the sand. He said many times, if Bitcoin falls below $74,000, that ruins the higher time frame, meaning big picture expectations that he has for Bitcoin. So we would have to reassess at that point exactly what that means. And that could mean we're actually in a bear market. Now, just because we're close at this point, it doesn't mean that we actually are in a bear market. For instance, just to give you historic precedent here, 2020, I was here for the pandemic fallout too. And, I think Bitcoin bottomed close to $3,200. And so Credible Crypto, I recall him, and I actually mentioned this in a video somewhat recently, but it's worth mentioning since I'm discussing it now. As we were approaching, I think $3,700 for Bitcoin. So that was close to the bottom for like March of 2020. People were losing their minds. It was close to the cycle bottom, which is at the end of 2018 of about $3,200. So we were $500 away roughly from getting back to the bear market bottom of 2018 in March of 2020. But mind you, before we fell down to that $3,700, we were at $14,000. So we went from $3,200 to $14,000 down to $3,700, and people were calling for a $1,200 Bitcoin. And yeah, we did get really close to invalidating that higher time frame structure, which Credible Crypto in March of 2020 called, but we didn't. So yeah, we're fairly close to $74,000 now. And if we retake it's possible, then we'll talk about it. And maybe that does mean we're in a bear market. We're not there now. And there's historic precedent to indicate, yeah, you can actually get really close, but then you just blast to highs. And especially considering the macro backdrop, I would not be surprised if that's the case. And the good news is, if my suspicion is wrong, and it could be, but my conviction is what it is, if my suspicion is wrong and we enter a bear market, then we'll be out of it historically probably in about a year, and then we're still going to go up from there. It's going to trend up, and then you're still going to have eventually another euphoric blow off top. Because we didn't get one this time, did we? Markets will get hot again, though, regardless. He's not the only one calling for $74,000. Here's chart analyst Malius, just another example of an analyst that's calling for about the same thing. He says $74,500 is the bull market invalidation level. So there are lots of analysts I follow that keep talking about this level. And the reason that level is important is because after we broke through that all-time high, the previous all-time high last cycle of like $69,000, when you got to $74,000 roughly, that was the taking off point. That's where you had a true impulse. And so structurally, chart analysts will tell you, as long as you stay above where that impulse began, then, maybe it can persist. But as Credible Crypto has said many times for a long time now, you fall below that, yeah, but maybe we got a problem then. But he does not believe that's going to happen. Here you have Scott Milker, the Wolf of Wall Street. He's one of the more popular analysts in crypto, 1 million followers. Says 74,000 is strong support. Says, I will buy more if we get there. If that breaks, the real opportunity becomes more likely. $55,000 Bitcoin. So at that point, you're talking about a much steeper drop, in which case I would find it much more convincing at that point. We'll assess at the time. I would find it much more convincing we're in a bear market if that happens, in particular, if a bunch of cycle top indicators are triggering. So far, by the way, before recording this video, I checked and none of them have triggered yet. And who knows, maybe some of them are getting close to the threshold of triggering, but none of them have at this point. And I'm just telling you, there are historical norms to indicate that you can get this low and it's not the end of the world. Just take it for what it's worth. Here's a post from chart analyst Psychedelic. He says, this is absolutely wild. I am speechless. And by the way, this is at 4:46 a.m. So Bitcoin was around at what, $82,500 when he posted this. He says the current 1 week relative strength index has just tagged oversold levels that we have only seen before at 2018 bear market bottom, the COVID bottom, 2022 local bottom at $18,000, and Bitcoin is still in higher time frame structure at $82,000. The only time the RSI has reached these lows has been at the very end of full-blown bear markets and the COVID black swan. There is no precedent for this. We are seeing something totally new for the market here. Peak bear market lows on the RSI within 6 weeks from the $126,000 top, just insane. Okay, now that is true, especially if you consider the macro backdrop. We haven't seen something exactly like in this in a different way. And I'm not saying like the famous phrase, this time is different. I don't quite mean it like that. In fact, I mean it in the way that because if we are entering a bear market now, things are so different. That's what would be weird. That would be the strange thing if we're actually entering a bear market. But if something structurally broke, which I think is true, and it doesn't mean it's going to crater us down disastrously further, even more disastrously further from here. It does seem to be the case. Raoul Pal was talking about it. Raoul Pal, of course, very, very famous guy in crypto, 1.2 million followers for a reason. He's the reason that I am aware of the important correlation and causation between Bitcoin and global M2. Because it turns out it is global liquidity. To be clear, there's no one metric that's the end-all be-all that you can just track and know what's going to happen within markets. But global M2 is as close as you're going to get to that. And he's the reason that I am aware of the importance of that. He's also the reason that I understand why debt refinancing changed. So we've had this 4-year cycle ever since the great financial crisis. And the reason that it set off as 4 years is because once the economy was on fire in 2008, tons of businesses had to refinance debt exactly at the same time. That set the 4-year cycle. That's why we've been seeing it since then. So why is it changing now? Because of the pandemic. The short answer is because of the pandemic. And I learned this from him also. Because as soon as you got to the point where firms needed to refinance, they did it in an environment where interest rates, because of the pandemic, were 0%. So they, instead of having a 4-year, they extended it out as far as they could. And some longer than 5 years. Some did more like 6 years. It just averaged out to 5 years. And so once he saw that data, and he was talking about this, about a year ago, he could see this, and he was warning a year ago. It's like, hey guys, he actually, as a result of this could very much change the liquidity cycle. It'll change when people are refinancing. That'll change the business cycle. And he said that's why you could see this market cycle drag out more than 4 years and go into the first quarter or second quarter of 2026. He was talking about that a year ago. I shared it on my channel close to a year ago. It was either late 2024 or early 2025. I was highlighting it that long ago because I found it to be an interesting thesis. And not that nobody's right about everything, including him, but he's got a great track record. He's a very smart guy, and he's got a decades-long career in finance. It's worth hearing his perspective. And he stands by that today. Just to be clear, he absolutely stands by that. He does not think that we're in a bear market. He thinks we're going to go much higher. And he's also highlighted what I'm going to talk about for the remainder of the video, which is what I was referencing at the outset of the video, that the fact that something is broken at the moment. Look what Raoul Pal had to say. I'm not going to read this whole post, but the relevant portion is right up top here. And he posted this morning, 7:36 a.m., so just hours ago. He wrote, utterly brutal crypto markets with relentless, rapid positions unwinding, and rumors swirling after October 10th of impaired market maker balance sheets leading to less liquidity and someone blowing up. Okay, when he says someone blowing up, he's talking about a single large market maker. And I'm going to talk more in depth about that. I've got a bunch of things that I want to say about that. I want to kind of break it down in a fair amount of detail. But first, I'm just going to highlight what a few individuals are saying about the matter. So there are people in the know that have heard through the grapevine, yeah, this is indeed the case. They just don't, nobody said the name publicly yet of which firm this is, but they're still solvent. So, and that's a key thing. Whatever firm this is, if this is true, they're still solvent. And that's true. And it makes sense because, you know, obviously some sort of financial institution would have lent them money so that they could engage in their market making activities. Well, the last thing the lender would want is for the market maker to become insolvent, because then they never get paid back. That wouldn't be good for them either, and that could mess up their books too. So it's in their interest to just kind of make them sell and then just allow them to limp along and then kind of heal. They're wounded but not killed, basically. And so that is what it looks like is happening right now. It looks like a bunch of forced selling here. Here was Cryptos R Us, popular analyst. He shared a video clip from CNBC where Tom Lee was speaking. That's this guy right here for those of you looking at the screen. He is a co-founder of Fundstrat, very famous firm. He's a CNBC contributor. And look at what Cryptos R Us had to say about this. He was kind of summing up what Tom Lee said on the segment. And he wrote, "Crypto didn't break, market makers did." And folks, I'll just pause a note. When I said something broke, that is exactly what I'm talking about. Anyway, and then he reads as follows. Tom Lee says the real reason Bitcoin and ETH have been bleeding since October 10th is the massive liquidation shock that crippled market makers. A stablecoin mispricing triggered ADL, that's auto deleveraging, across exchanges, wiped out nearly 2 million accounts, and left market makers short on capital, shrinking liquidity ever since. When liquidity dries up, every dip feels worse than it really is. In 2022, it took 8 weeks to flush out. We're 6 weeks in now. Think about that, folks. That's a key point. That's why I was saying, and I'm going to circle back around this, but that is an excellent point. In 2022, it took 8 weeks to flush out the system when you had market makers that were in trouble. We're 6 weeks in now. And by the way, structurally, that would be normal. For situations such as these, whether it's traditional finance or crypto, it is normal for it to take that long. That is 8 weeks is pretty standard. It can be less, but it's actually quite standard, which means we're at the end of this, and it's contractual. If this is indeed the case, and there's evidence that it is, you can see it in the market, folks. It's not just wild speculation here. It's not just a word through the grapevine. You can actually see it in flows on chain. But these are contractual agreements between market makers and their lenders. They don't go on forever. And so anyway, and then he says this isn't a new bear market. It's the leg effect of a huge liquidation event unwinding in slow motion. When liquidity normalizes, crypto usually snaps back fast. And by the way, that is exactly what Tom Lee said. After these types of events, after these huge liquidation events, and after, in this case, it's a market maker, say it's one big market maker. In theory, it could be a few small ones, but it's almost certainly one large one from what I've heard and from what you see on the books or on the blockchain. Once the selling's done, that pressure, it's gone, and so you just snap back. I mean, if you're not in like a true traditional bear market, you snap back. That is what happens. You just rocket out of there. There's historic precedent for that in crypto. That is what I'm telling you. Negentropic, they highlighted this too. Check out this thread. Now, Negentropic, this account is run by the co-founders of Glassnode and Swissblock, which are both on-chain analytics firms doing fantastic work. And this is insightful and it's correct. And more people just started talking about this because there's been more analysis recently and because the rumors have been flowing through the grapevine. I just haven't seen a name yet about which firm it might be, but it's flowing. And especially Tom Lee talking about that on national television, that got everybody talking about it, honestly. So anyway, here's what Negentropic had to say. What's happening in Bitcoin right now isn't a narrative shift. It's a mechanical unwind. The data is pointing to something very specific. A forced seller that blew up around October 10th and has been offloading in a constrained, systematic way ever since. And here's why. The one-day MACD just printed a new all-time low, yet price is only down 33% from the highs. This doesn't happen in natural markets. You only get this when someone is dumping in a straight line. No pauses, no reflex, no volatility resets. And so, folks, you can see what he's getting at right here. You can see, if you just look at the data, that there's something consistently unfolding here. And it doesn't look like a normal, traditional, organic unfolding of a bear market. It looks different than that. That's what he's saying. And then he wrote, RSI is sitting near capitulation levels, but there's no macro stress, no credit shock, no leverage detonation, no ETF outflows. Well, I got to pause and I got to correct that. There were ETF outflows for Bitcoin specifically yesterday. They were pretty large, and I'm surprised you didn't catch that. But for XRP, actually, they're massive. I'll probably talk about more about that in a separate video. There's actually a lot of good stuff happening. You just don't see it necessarily in price. That's what's on forefront of everybody's mind. So of course I'm talking about it. But anyway, he says it's extreme momentum without a catalyst. Classic signature of mechanical selling. That is spot on. Yes, that's the thesis. The data supports that. We can't technically know for sure. And yes, I admit this is speculation technically, but my God, it looks like the stars align on this. It really does. And then he says, in every past moment where these indicators were this stretched, price was down 60%, derivatives were blowing out, funding was deeply negative, and none of that is happening now. Folks, please think about this. Think about how bad things actually were in 2024, or not 24, in 2022. Think about how many firms actually blew up and no longer exist. Think about the actual Ponzi scheme, FTX, and the serious damage that was done to the crypto space. And by many metrics, what's happening today, price-wise, is worse than that. But nothing's structurally, permanently broken. You're not seeing companies blow up. You're seeing a wounded company. Almost certainly. You're seeing at least probably one very large wounded market maker. That's what we're seeing right now. Anyway, and then he says, ETFs remain net positive. Their cost basis is still intact. That's true. Long-term holders are removing supply aggressively. Solana ETF inflows are steady. Altcoins are holding up relatively well versus Bitcoin and ETH. ETH is holding stronger than Bitcoin. If this were real sentiment, all of that would be breaking. It isn't. The flow pattern since October 10th is identical. Same timestamps. This is crucial. Listen to this. Same timestamps. Same venue-specific thinness. Same lack of reflexive bids. It's a schedule, not a market. We have seen 21 days of consistent toxic flow. That's right, folks. You're seeing selling that is occurring as a pattern, not organically. If it were just the market and we're getting in bear territory, there'd be random days where it'd be worse and you wouldn't be able to make heads or tails of it. That's not what's happening here. What's happening here, and it's just data, which is why, fine, it's technically speculation, but come on, guys. Come on, McFly, come on. It's pretty obvious here that what is almost certainly happening is that you're seeing the actions of a wounded market maker. And so then he says, all of this aligns with one explanation. A liquidity provider or fund was structurally damaged on October 10th, creating a hole in the book, and the entity tied to that failure has been reducing risk in a forced, rules-based manner. And I'm going to talk more about that, actually. But let me go through this. The broader cycle structure remains intact. Higher highs, higher lows, strong spot bid, strong ETF demand, macro neutral words are hard, neutral to bullish. The stress is isolated to one participant, not the system. This is not capitulation. This is not a trend break. This is a constrained unwinding through a fractured market. And when that flow finally exhausts, the rebound will likely be far sharper than the decline that preceded it. And folks, that's right. That is reasonable speculation, and that is in line with what Tom Lee was saying as well. And he posted that this morning at 4:16 a.m. So, let me walk you through the thesis a little bit further, though, because, again, if correct, it completely changes how we should interpret the recent XRP and crypto crash and everything happening right now, frankly. And like I was saying earlier, the best part is, if this thesis is right, and I believe we're on the right track here, it's actually very good news for everyone invested in crypto. So if you've made it this far in the video, I'm glad you're still here, because I want to talk more about why, if this is correct, we're almost certainly at the end of it, and things are about to get a lot better. Now, it doesn't mean they can't get worse first. I'm not saying that you won't or can't see lower prices than where we are now. But as long as we hang out above, at least where Credible Crypto was talking about, if it doesn't break the higher time frame structure, if things aren't so blown out that we hit that, it's going to turn around almost certainly, right? That would be my guess anyway. Nobody knows for sure. I'm just telling you what I think. I think it's reasonable speculation. It's a fun conversation, right? At a minimum, all right? But I'm talking about the idea that the selling we've been seeing, to be clear, it isn't sentiment. It's not driven by sentiment. And again, it's not driven by fundamentals either. It really is coming from almost certainly a single large liquidity provider, a market maker, who was structurally damaged during the October 10th, of course. And look, I think it's very obvious they've been forced to sell by their lender. All the crypto that they hold, of course, so that would include everything literally, which is why we're seeing what we're seeing, that Bitcoin, XRP, altcoins in general. And there are tons of signs that this is the case. Which is why, again, I think it's great news. And let me cover a little bit of ground though first, because there are a couple things that I want to make sure everybody knows, because if you don't, then some of the stuff I want to say in like a minute after that isn't going to make any sense. So I just want to make sure everybody understands like the nature of market makers, because that's what we're talking about here. And to be clear, market makers, they are the firms that provide liquidity on exchanges, and so they aren't speculators. They don't invest in Bitcoin or XRP or anything else the way that like you and I do. Their job is to offer buy and sell orders, and that's what they do all day on cryptocurrency. Cryptocurrency exchanges we use, it doesn't matter what the exchange is. Coinbase, Binance, for example, doesn't matter. You name it. So they do that so that people can enter and exit trades. They make it so that the liquidity is there. And what's liquidity? Of course, it's the buy and sell offers. And so why are they there doing that? Because they can profit off the spread. And so the moment the moment they buy Bitcoin or XRP or any asset, it doesn't matter, they immediately hedge that exposure on another exchange, or with a futures or a perpetual contract. So their net exposure is effectively zero once you hedge. And so again, like I said a second ago, they make money from tiny spreads and also arbitrage opportunities. That's true too. But they don't make price from betting on price direction of any cryptocurrency. They're not hodlers like you and I. They want to hold whatever crypto they buy. They want to hold it as briefly as possible. They want to buy it and they want to find somebody to sell it to as quickly as possible. And they do it for tiny, tiny, tiny margins, but then they have high volume, which makes it worthwhile. And then that becomes a lot of money because it's high volume, but it's very small margin, and just to be clear, market makers, just to be clear, just because they're doing this, it's not like it doesn't mean that they're not like necessarily anti-crypto or anything like that. And there could be like a short-term stash that they're holding for like a couple of reasons. I just don't want to get too far into the weeds. I'm just saying, on the whole, it is not their job or their intention to hold a crypto for any long period of time. The moment they buy Bitcoin or XRP on one exchange, they immediately place an offsetting trade somewhere else, and that cancels out their exposure. That's called hedging. That is what it is. And it means that if the price goes up or down, they don't make or lose money. They stay neutral. They're only trying to make money, again, on the spread, which is simply the difference between what they pay for an asset and what they ultimately sell it for. That's the spread. That is what it is. I just want to make sure people understand these basic things, or else the rest of what I say ain't gonna make sense. But on October 10th, those hedges didn't execute because exchanges were lagging and exchanges were mispricing. So they ended up unintentionally holding huge positions at the worst possible moment. This was not intentional, folks, okay? To put it bluntly, everything broke effectively at once, just about. Exchanges lagged or they froze. Order books evaporated. And some exchanges, like I said, mispriced Bitcoin by thousands of dollars actually relative to others. So market makers who were doing their normal job, buying across dozens of trading pairs and hedging instantly, they suddenly couldn't execute their hedges. That's not safe. That's definitely not safe. They bought assets, of course, yes, intentionally, but weren't able to hedge because the system broke. They didn't know that was going to happen. And that's how they ended up accidentally exposed. They normally hedge against, so that directionally, no matter where the market goes, they're fine, but they couldn't execute the hedge. And so they weren't just stuck with massive quantities of Bitcoin. They were stuck holding Bitcoin, Ethereum, Solana, XRP, and a whole bunch of altcoins that they normally would have hedged instantly. So these firms, they make markets across, almost the entire ecosystem. But, just to reiterate, when everything broke, it didn't just leave them holding Bitcoin. It left them holding a ton of assets that they never wanted to hold for long periods of time. Assets they didn't want to keep. Because again, they were only trying to make profit on the spread. But since they could no longer hedge against those purchases, they suddenly became subject to whatever direction the market would end up going. And of course, as you know, on October 10th, you saw that story play out, didn't you? That direction, it was down dramatically. And the trigger was Trump talking about tariffs, yes. That was the trigger. Everything fell apart at that point because it was that dramatic. We were teetering on the edge. And so this is all bad for a market maker because they're not in the business. Again, they're not in the business of betting which way the market goes. They're in the business of making tiny profits off the spread from individual transactions. And so they were subject to unexpected volatility of this degree during a severe crash. Not good. Definitely not so good. And because the price was falling so fast during the October 10th crash, those positions created serious losses, obviously. To put it lightly, right? I mean, it was the biggest liquidation event in the history of crypto. 20 billion losses, roughly, for the entire market. And so anyway, when that happens, though, a market maker's lenders step in immediately. And so, they tell them, reduce exposure. Right away, of course. They tell them that right away. It's not that they reduce it all at once. I'm just saying they tell them right away, hey, got to take action here. But they don't, of course, they don't unload it all at once because that would destroy the market. Okay, but gradually, basically every day for weeks until their risk is back within limits. Yeah. So this creates a steady stream of forced selling. So it's not emotional. It's not sentiment driven. It's not investors panicking that caused the downfall. Although after it started, yes, people did panic sell. That wasn't what started it, though. Again, it's a wounded market maker that was forced to sell the crypto that they held because of the lending contract that they had from their lender. So for example, maybe they got a loan from, maybe it wouldn't necessarily be a bank. It could be a prime brokerage firm. It could be some sort of other financial institution. Probably not a bank. It could be a bank. But they get a loan from a financial institution so that they could buy crypto, so they can conduct their business. And the contract they signed with that lending institution, of course, it would have parameters in place that would cover situations just like this one, which is catastrophe. So the market maker would be contractually obligated per an agreement with their lender to sell a certain amount of the crypto they held over a certain amount of time. That is exactly what Tom Lee was talking about. It's what everybody's talking about now. And that is what happens in these environments. It's true in traditional finance. It's true in crypto. And in normal time frames, this is where it gets exciting, though. So normal time frames for situations like this, like honestly, both in traditional finance as well as crypto, typically from the research I did, it seems like mostly 20 to 45 days, but almost never more than 60 days. So, about 8 weeks. So, for example, like Tom Lee was saying, I think it was Tom Lee, I just pulled up a second ago, in 2022, the market makers that were in distress, they finished selling in about 8 weeks. And again, we're at 6 weeks now. Today, it's been exactly 42 days since October 10th. So, although we don't know exactly when the market maker will stop selling, it's perfectly reasonable to speculate that it's almost over because when it comes to forced selling like this, which again, I'll say it again, it's normal in traditional finance and crypto. When it comes to forced selling, there are standards within the industry. The standards tend to max out at 8 weeks. And we know for sure that we're seeing consistent selling, which is not the type of behavior that you see if it were just emotional panic sellers. It has every mark of being like a major market maker, a very large one. That's why I'm telling you, this is very reasonable speculation. And before I forget, here's one more important detail that really supports this thesis. Just to get into the specifics, since I'm talking about these patterns of selling, the pattern of selling we've seen since October 10th. It really just, again, it doesn't look like panic from like retail speculators or anything of the sort. The selling occurs literally. It's just like clockwork. It's throughout Monday through Friday. And also the sell pressure, it's actually, so check this out. It's noticeably heavier Monday through Friday when liquidity on major stock exchanges is deepest, and it's noticeably lighter on Saturdays and Sundays when books are thinner. Well, that's interesting, isn't it? That's exactly how a forced seller behaves when they're following a sell schedule set by a lender. They execute more of the required selling during high liquidity hours to avoid blowing themselves up again, right? And they scale back the size of the sale during low liquidity periods like weekends. That's a classic signature of a single impaired market maker selling as contractually required by their lender, not widespread fear or a broad market exit. That's exactly what it looks like. And so, of course, someone might ask, but sentiment is terrible. The crypto fear and greed index is an extreme fear, and that is true. It's an extreme fear. Doesn't that prove that this is sentiment-driven crash? And no, that's a misunderstanding of the order of events. Sentiment did not cause the decline. The decline caused the sentiment. So, if one large market maker is unloading inventory, every single day because they were forced to, the market grinds down in an unnatural way with weak bounces and weird momentum readings. That grind is what makes people fearful, but fear's the reaction here. Clearly not the cause. It's order of events, my friends. And the most bullish part about this thesis, it's what's the conclusion, which I actually kind of told you at the start. If the selling isn't coming from the market broadly, and it isn't coming from investors abandoning crypto, then this is not a bear market in any traditional sense. It's a temporary liquidity distortion caused by a freak breakdown in market structure on October 10th. That is exactly what this is. And when the forced seller finally finishes selling, and that day will come, the pressure, I'll say it again, I said it a few minutes ago, the pressure lifts immediately. So what happens then? Well, I have a few ideas about that. Markets stop cratering down, okay? Liquidity comes back. Normal price behavior returns. And historically, when forced sellers finish their selling, the rebound actually is sharp. And that's exactly what Tomley was telling you. He's not just making that up. That's historically what you see after these types of events. We're just living through it right now, so it's not fun. And hopefully it's not so severe that we enter a truly devastating bear market, which I do not think we have, and I don't, unless something changes. Like I'm skeptical of the idea we're going to enter a bear market right now. Rob Powell very well could be correct that the market peaks, in the first half of 2026. We'll find out together. He could be wrong too, and I find his thesis compelling, and maybe I'm wrong for believing it, but I do find it compelling still. But yeah, it's true. Like prices, they really do tend to snap back far faster than they fell. So, I'll just say, if the thesis is right, then what we're watching right now, it's not the end of the crypto cycle, folks. It's not a failed market. It's not some macro catastrophe. Macro actually looks pretty damn good right now. It's just a wounded market maker cleaning up a mess created during one of the most chaotic trading days in crypto's history. Doesn't that make way more sense? And when that process ends, the market should recover pretty damn quickly. Long term, nothing has changed. Fundamentals are intact. In fact, for XRP, the fundamentals have never been stronger. Adoption is intact. Liquidity cycles are intact. And again, macro looks great. Which means that, we're experiencing right now, what we're experiencing right now, it's not something to fear, it's just something to understand. And that's why I'm taking this time to make this unusually long Moon Lambo hot jam. And thank you for all listening to the end here. You just need to understand it, because I think a big reason people are fearful when they see something scary happening, like, your net worth going down substantially because asset prices go down. A huge part of the fear comes from not knowing. It's the uncertainty, the not knowing, that's the problem. If you knew, like, say this thesis is correct and you were aware of this, isn't that something that's going to make you probably less afraid? It helps me. I'm not going to freak out either way. Like, even if we enter a bear market, like, I'm not going to freak out. But I'm just saying, isn't it something that's helpful if you can just understand the landscape and why we might see this relentless selling that we've been seeing in recent weeks? Doesn't that help now that you know this? I think the answer, for me, the answer is I think it's useful. It should be useful for everybody, So, if the thesis is correct, and again, I personally believe it It is either largely or entirely correct. But if it is, then yeah, crypto investors actually have far more reason to feel relief than panic. Because this isn't the beginning of a bear market then. It's a temporary structural anomaly that will resolve on its own. And when it does, the move up could be violent. In a good way, my friends. I'm not a financial advisor. You should not buy or sell anything because of anything I say or write. That would be a very, very, very bad idea. Until next time, to the moon, Lambo.